Oh, so I'm going to go and get started. We have with us Danielle and the Harvard Alumni Entrepreneurs Forum in case there are any technical difficulties. So hello, everyone. The Harvard Alumni Entrepreneurship is happy to welcome you to the 2020 Fintech series. Harvard Alumni Entrepreneurship is better known as HAE, is a global community with over 14 chapters worldwide, connecting 14,000 Harvard alumni over entrepreneurship and innovation. If you want to receive our latest communication, you can join in by registering at harvardae.org. And Danielle, if you can put that in the chat box so that everyone will have a link to the Harvard Alumni Entrepreneurship, that would be helpful. Now, without further ado, let's start today's discussion, which is themed around exploring fintech industry post-COVID-19. My name is Inclusivity. I'm the co-founder and CEO of HPass, a healthcare digital startup, and I'm going to be the moderator for today. Before I start, I would just like to ask everyone to mute yourselves in order to prevent background noises. We hope that all of you will participate in the panel by asking as many questions as possible, and we ask that if you have a question, please write it in the text in the chat box so that we will be able to take all of the questions in order as well and ask the relevant panelists. Before we begin, I will introduce our four panelists, and then we will open the panel for questions that we have prepared and you submitted in advance. The panel today will have four different subtopics. The first of which will be focused around the founder's journey. The second will be focused around fintech post-COVID-19. The third will be VCs and investment post-COVID-19. And the fourth group of questions will be focused around social impact. Following those questions, we will open it for Q&A from the audience, and we hope that you will participate and ask a lot of questions to make this event as interesting and as engaging as possible. So without further ado, I want to start by introducing our four extremely talented panelists. The first is Nami Baral. Nami, can you raise your hand? And I should have mentioned, perhaps all of the panelists have a background that says Fintech 2020, so you can recognize us. But if not, then we also have our names under our video. So Nami is the founder and CEO of Harvard's Platform, a fintech startup that utilizes artificial intelligence to eliminate bad consumer debt, from fees to credit card charges to student loans and more. Harvard's Platform is headquartered in New York and is backed by investors including Barclays Capital, Kleiner & Perkins, Lakehouse Ventures, as well as founders of Warby Parker, Acorn, and many more. Nami graduated from Harvard University with a degree in economics and mathematics. And Nami's fun fact is that she's originally from Nepal. She probably holds the world record in the number of times she has been asked the question, have you ever climbed Mount Everest? So Nami, thank you for joining us today.
Yes, absolutely. I'm so happy to be here and looking forward to the conversation.
Our next panelist is Chanel de Silva. Chanel, can you raise your hand? Great. So Chanel is the co-founder and CEO of Vincers Health, an innovative fintech and health tech startup fighting tobacco addiction. Chanel holds a Master of Public Health from Harvard, a Master of Finance from the University of Cambridge, and a bachelor degree in math from the London School of Economy. Shalen's fun fact is that he's an Australian Sri Lankan with a green card in Hong Kong who spent most of his life in Singapore and in the UK. So in the Q&A, please try to avoid asking him the question that he can't answer. Where are you really from? Thank you, Shalen. Our third panelist is Soha from _VC. Soha, can you raise your hand?
Hi, everyone.
Soha is a fintech nerd with investment expertise across emerging markets, in, in Quana Capital and domestic markets at Bain Capital, and today at Underscore VC, a Boston-based VC backing bold entrepreneurs from early stage. Silva holds a dual MBA and Master of Public Policy from the Harvard Business School and the Harvard Kennedy School. Thank you, Silva, for joining us.
Thank you. Pleased to be here.
Our last panelist is Michael Madan from The Art Ventures. Michael, can you raise your hand?
Pleasure to be here.
Michael is the founder and managing director of The Art Venture, a Harvard alumni venture fund investing in Harvard alumni-led companies. Michael holds a BA from Harvard College and an MBA from Stanford. Thank you, Michael, for joining us and for your insights. So without further ado, I want to jump straight to the Q&A. And we've assembled both questions from the panelists, as well as questions from the Harvard alumni entrepreneur, as well as questions that were pre-submitted by the audience. And the first group of questions surrounds around the founder's journey. So this is a question to both Shalen and Nami. Can you maybe tell us a little bit about the hard decisions you had to make while starting a company? And I want to focus on the fact that both of you left behind very lucrative careers in order to not take a salary, work long hours, and try to build something of your own.
Yeah, absolutely. For a little bit of background, when I graduated from Harvard, initially I had a career in finance through my first job, which was in investment banking, and I was doing M&A for really large cap companies. Obviously, how lucrative M&A is just from a just compensation perspective, and also you get a lot of you get a lot of experience, to say the least, right? Not the easiest job, but definitely something that is highly sought after. And after doing that for several years, I decided to go into tech, join Twitter pre-IPO, and stayed on at Twitter for another 5 years post-IPO. And so around the time I left to start my own company, Harvest, I was in charge of a team that was doing more than $1 billion of annual revenue. And I did have a very cushy job, almost rest and vest kind of job at Twitter. Obviously it is always difficult, when you leave a job that is extremely stable, where you're, used to getting a good stable paycheck every 2 weeks. And it also comes with a lot of perks, benefits, especially if you want to start a family. It's also a very difficult decision to, just completely leave all of that and start your own company. But I think the hardest decision in starting a company is to actually, really understand that the opportunity cost that you're leaving behind to do this startup is really, really, really high, especially if you're at the prime of your career. And so, I think the decisions that, I had to take in the beginning was just around, really being comfortable with that opportunity cost. But then also, I think, just thinking about other obligations that you have set out for yourself and being okay with it. In the end, though, I do think the hard decisions are much easier when you think about, just the passion you have for wanting to start that company, right? It's almost harder to stay on the job and not start your own thing if you truly, truly, truly believe in that dream and the vision. And I think ultimately that makes it a much easier path, because you know that you're going to have to do it, and you want to do it so badly that you don't care about other things.
Thanks, Nami. Shalen, how about yourself? Tell us your story.
Yeah, I mean, that's where Nami left off. It is the perfect insight. I spent nearly a decade working in finance, in LBOs across Asia, structured finance in Singapore and in London. And the fact was, I was miserable. My heart was never in it. Like I knew this deep down right from the start, but the money was too tempting to kind of say no to. And in hindsight, I picked up a lot of great skills, but at the end of the day, as an ambitious and motivated person, you don't want to be mediocre or disengaged with your day-to-day work. And for me, that was like a real source of anxiety. And I knew I wasn't kind of applying myself in my time honestly, really. So I took the leap. I had started an NGO when I was in Singapore. I'd done a lot of work in the healthcare space on the side as a side gig, but I soon realized, well, it took me 5 years to realize that that wasn't enough to feel fulfilled, because your day-to-day work needs to feel like it's important. So I took the plunge and signed up for a master's in public health. I think that just, for me, there wasn't really a decision to start a company. It was like an organic path following the breadcrumbs to like solve a problem that you couldn't help but, tackle at any cost. And, I didn't have to make a decision to leave anything behind, because it was already a foregone conclusion that that wasn't for me. And there's nothing else that I'd rather be doing. And if you don't have that attitude, it's very hard to survive the punches in the face that you get along the way, and the hundreds of no's and pitfalls of being an entrepreneur. And, I'm still getting punched in the face every day today. And it's almost a pleasure, you like the taste of it after a while.
Wow. Thank you for those insights. So, and I definitely can resonate with the getting punched in the face part of being an entrepreneur. So I want us to move to the second pool of questions, which surrounds around the fintech realm and how that has changed during the COVID-19 era. But before that, I want to introduce a poll in order to wake up everyone here who closed down their camera. So Daniel, can you help me out? We're going to ask the following question. What sectors, in your opinion, are fintech startups becoming more prominent in? Please give us your honest answer, and let's see what do you think? Daniel, how do we get to see the answers? Wealth and investment. Nice. Although it seems that there is over 20% in each of them. It seems that most people voted more than once, because I count more than 100%, which is interesting. Great, thank you. So in fintech, my first question, Soha, is to you. There have been a lot of recent trends in fintech, and as an investor, I'm sure that you've seen many of them. Can you maybe talk about the most prominent fintech trends that you've seen pre-COVID and then post-COVID, and how has that changed?
Yeah, happy to speak to that. And obviously, COVID-19 has impacted many industries, and we're living through incredibly challenging times right now. And particularly, fintech companies are also no exception, and many customers, particularly in the SMB segment, have been brutally prioritizing their spend in the face of tight budgets. So you've seen that kind of have its own ripple effects across many companies. You've seen Toast, for example, which is already valued at more than $5 billion, laying off 50% of their employees. Cabbage also furloughed a significant number of workers. And even yesterday, some of the news came out around Scale Factor, which offers software that automates back office tasks, including bookkeeping and payroll, is shutting down completely after raising $100 million. And they were targeting the SMB segment and really struggled to continue to sell into this market, given that revenue streams have dried up completely.
В принципе, на Геройство игра 12Е. Дмитрий, ко мне собирай.
Oh, sorry. So there, it sounds like we had an issue there, but their revenue streams totally dried up as customers were forced to cut down their own costs. And so it is no easy time for the fintech world, non-fintech world overall. But with that said, we've actually seen some of the best companies get built during moments of crises. And this has been echoed over time. And I want to actually even reflect on the last major crisis in 2008, the financial crises that actually spurred innovation in the financial industry, and some of our fintech industry's darlings were born at the brink and following that crisis. So a lot of the companies now that you see as unicorns and that are touted, everyone from Credit Karma, NerdWallet, SoFi, Square, Venmo, Stripe, TransferWise, the list is endless, but this was all a series of companies that actually came out of the financial crises. So for all the entrepreneurs that are getting beaten up every day and getting punched in their face, I just want to encourage you that because despite the challenging times, that these moments of crises actually are also an opportunity. And when customers' budgets are tight, I think it actually forces only the startups that are truly solving the biggest problems of highest priority to customers. And those are the startups that will survive and thrive during moments of crisis. So it weeds out a ton of players for sure, but the ones that are able to do that actually take off significantly even during these difficult times. And it's interesting to reflect on what's happening with COVID-19 now. It's clearly a healthcare crisis at a global scale, totally unprecedented. And we're watching the healthcare industry going through major tectonic shifts that will probably never look the same coming out of this crisis. So I actually find where health tech meets fintech to be a very interesting intersection that one of our panelists are also speaking to. And I personally was most recently a product leader at one of the health and insurtech unicorns in the area called Devoted Health. So it's a space that I've been watching and eagerly kind of seeing new trends. So with major changes happening in reimbursement regulations and digitization of healthcare and pressure to shift to value-based care, it's inevitable that there will be some winners at this intersection. And if you're building something in that space or exploring what that could look like, I'd be happy to chat and look forward to hearing more from folks in this group as well.
Sue, I think there was a really interesting comment nested in there, which is what we've seen in entrepreneurs live, where disruption leads to innovation. And the opportunities that unfortunately have been thrust upon us over the past 3 or 4 months, sad in so many ways, but opening up brand new opportunities for smart, talented, passionate entrepreneurs to be able to lead the next wave of innovation. I think from our perspective, pre-COVID, if you ask me some of these questions over the winter, as it relates specifically to fintech, we're more generalist investors by nature, but we've started to see across our portfolios about 480 companies, the vast majority of which they wouldn't describe themselves as a fintech company, but they need a fintech strategy. And whether it's the integrations, whether it's around payments or know your consumer, there's just all these different types of sensitive regulatory and fintech type whole teams devoted within these companies that maybe 5 years ago didn't exist. So it's fun to be able to piece this together and make all of the connections. I think to further emphasize some of the points that have been made here, we've kind of seen 3 buckets, not of equal size. Those subsectors that really are having a boost or a benefit, if that's not the right term to use, but many of the macro trends that we've all seen coming over the past 10 years just really accelerating. There's the other side of the spectrum, which is companies in travel and hospitality and these certain subsectors that have had to go dormant. They've had to hit the hibernate button to come out on the other side, as we know the world is returning and being in a strong, well-funded place. And then the biggest bucket is everybody in between. And so doing our best within our portfolio, and I think we'll talk about it a little bit later, to help be supportive, to back a lot of the great entrepreneurs that we've had the pleasure to work with.
Thank you so much, Michael and Sohan. Great insights. And I wanna ask a follow-on question to Nami. So Nami, you have raised two rounds already. And you're aware to how hard this is, especially as a female, especially in a startup that has an impact factor into it. And I was wondering if you can talk more about the fundraising side of investment, especially now during COVID-19, and how do you see from your angle as an entrepreneur, how investors are investors taking a step backward? Are they more cautious, or do you see more opportunities to fundraise?
Mm-hmm. Yeah, so I have raised two rounds. Both of those rounds were pre-COVID, but obviously, there are certain kinds of patterns that that you see in all fundraising aspects, right? So, whenever you're fundraising, it's hard to fundraise as a founder, regardless of what industry you're in, regardless of whether you're a male or a female, or some other definition. But at the same time, there are certain things that every founder needs to know to really master that process, right? And I think the most significant factor of that is just making sure that you're building the network. And why do I say building the network is the biggest factor? It's because, especially for first-time founders, right? Like, you really are, I don't think the industry is biased one way or another, but I think most investors, what they're looking to do, what they're trying to do is they're trying to find the next successful company. And inevitably, psychologically, there is this pattern matching that comes into play. Not intentional, but it's psychological. Everybody thinks about who was the last successful person that they know. And often as a female, you have a lack of those kind of pattern matching history, because there is not that many female founders who have walked the walk before. So the biggest part of that is raising successfully as a founder. You need to spend a lot of time in building up your network, because once you build up the network, once you get those warm intros, it helps kind of get over that hump of having to pattern match, or having to be that match proactively. And then second, it's really about what kind of thing are you selling, especially in this environment. It's you have to be selling a painkiller and not a vitamin, right? I think everybody talks about that, and I think it's so true. And that has always been true. Those kinds of painkillers tend to always get a lot of attention. Nothing against vitamins, but you have to make sure that you're really expressing your vision and dream, and the ability to build something big, really big, hairy, ambitious. That needs to be your goal, and you need to be able to convey that properly to the investors, because at the end of the day, they're investing in the figment of an idea right now. Most companies are built over tens of years, and the things that you're building are going to change over time. But if you are able to give that confidence as a founder to the investor that, hey, you can trust me, I'm going to build something big, give me the ability to essentially iterate and produce these things. I think that confidence and that vision is what every investor is investing at the end of the day. And I think a lot of that takes practice. You also need to surround yourself with mentors and talk to a lot of investors before you start actually going to ask them for money, because ultimately it's a network play and a confidence play.
Thank you, Nami. Shalene, do you want to add something to the fundraising side of things?
Yeah, I mean, I have great respect for people like Nami who have crossed the chasm on the institutional fundraising side. On our end, we're earlier in our journey. We've raised money from angels and been part of accelerators, and we're just on the cusp of raising that seed round. I think we were kind of having to traverse the COVID period and adjust accordingly. And I think we did a great job of it. Also, our business model was set up to be exactly resilient and almost benefit from COVID as a telehealth platform, and as a platform that doesn't necessarily have to sell to any employers or enterprises. It's set up in a way that we can directly ping insurers. So we've actually had a lot of adoption of our product from partners who we were chatting to, and suddenly what they thought was a vitamin turned into a painkiller because they couldn't access their user base through the conventional means. So they needed a virtual product, which is what we offer. I think, you know, completely agree with the kind of observation about first-time founders. I think going from 0 to 1 is the hardest part, and obviously the biases that exist may not necessarily be kind of deep-rooted as a result of, you know, racial or gender biases. Perhaps it's just pattern matching, and they just don't have enough of a data set to, you know, judge you on if you're a first-time immigrant founder who's not really got a deep network in this country as I am. But, you know, I think we've been extremely lucky with the Harvard community and the communities that we've been part of through the accelerators. And I think building businesses with social impact is actually a good business strategy, because chances are you are a painkiller and you are a necessity, and you are resilient to the tough times when you're actually adding social value in addition to the financial value.
Thank you, Shailen. So I want to move forward to the third group of questions. And by the way, if there are any questions from the audience, please feel free to write them down in the chat so that we can start accumulating the questions for the open Q&A part. The third group of questions surrounds VCs and how do you guys think of fintech? How do you do due diligence? How do you invest? But perhaps before we start, I want to introduce another poll question to the audience, which is, what stage do you think that angels what stage do you think that angels invest in? Let's start with that, and we can use the results of that poll to help us direct Michael and Soha as they answer. So Daniel, can you show us the answers? Am I the only one seeing them, or are everyone seeing them right now? Everyone, great. Okay, so most people got it right. Pre-seed, again, we have more than 100% participation, which is great. I assume it's just that most of you clicked more than one button. So with that, let's move to the third bunch of questions about VCs. And we can start with the due diligence process. So there is that stage where you decide that a business is worth exploring, and then you don't write them a check, right? You tell them, let's go into due diligence, DD. So Michael, when you make such a decision, what drives you and how do you look at that process?
It's a very interesting question with probably a longer answer that's trying to narrow it down here. Not to get too far off track, we are so broad in our mandate. We invest anywhere from pre-seed up to significant later stage growth rounds and across all industries. We have a fairly unique take where we're a small strategic co-investor in every round. So we're never the lead. We're never the ones negotiating the terms. We're a smaller part of a larger syndicate. Ideally, to the point made earlier around networks and around community, ideally we would have known and built a relationship with a company years in advance. It's not always the case where you're that fortunate, but being able to track things over time and understand the milestones and even understand the struggles, I think is really important. When you're arriving, this leads to unsolicited advice for entrepreneurs to keep interested parties aware of how things are going on a quarterly basis, if that's possible, with a investor or advisor list. I just think it's so important to give people the confidence, to give investors and VCs the confidence where they've been able to learn and grow with you over time instead of parachuting in during the time of a transaction and doing their best to get a handle of what has gone on. right? Because what you tell somebody has gone on, and here's what the last 12 months or 24 months has looked like, it's really hard for a new entrant meeting you for the first time to digest it and have the same conviction as if they had been riding sidecar in whatever form that means for you over the past 2 years. So not a very clear answer, and I apologize, but really for us, when they're raising a round of capital, we look for the same handful of things in our investment strategy that need to be in place for us to begin.
Thanks, Michael. So do you want to add anything to that?
Yeah, sure. I mean, a lot of things that Michael shared resonates, but I'll share a little bit of the context for underscore VC specifically, because that also frames like what we look for. In terms of our focus, we actually are primarily a seed and Series A investor, focused in B2B software technology more broadly. And within there, I spend a lot of my time in the fintech and health tech spaces, which is why this topic and panel was very exciting to join. And geography-wise, we have a Boston bias, meaning we are very deeply invested in supporting the Boston startup ecosystem. We think it brings together some of the best talent across the globe, and is emerging rapidly with a lot of great companies. So it's our focus and mandate and actually mission to actually really invest in this ecosystem. So for that reason, we make occasional exceptions and invest in the pre-seed stage, particularly for student entrepreneurs that are coming out of places like Harvard and MIT and the local institutions that are bringing together great talent. So with that framing of where underscore typically focuses, we can lead, co-lead, or follow, so a little bit more diverse compared to Yard. And I think we probably have lots of opportunities to collaborate, Michael, in general as well. So we'd love to chat on that front. In terms of what we're looking for, many of you guys are probably already familiar, but in the end, as a venture capital investor, we're looking at team, product, and market. Those are basically the three major things. And at the earliest stages that we're investing, team is by far the most important thing that we're looking for and vetting against, because the product will likely evolve, markets will change with competition in various situations like COVID. The thing that doesn't change are the founders and their vision and their grit and ability to navigate all of that. So for teams, we like to see a balance of technical and business sort of operations expertise overall, and most importantly, some sort of unique, ideally like lived experience of having dealt with this pain point that you're solving yourself, so you can actually resonate and deeply understand the customer's pain point yourself, or some sort of deep domain operational insight that comes from your own experiences in the industry. So that's the ideal sort of profile if I had to kind of name like what we're looking for in the magical mix of founding team. And that's basically the most important part that we look at the team stage. And product and market, I think in the end, we're gonna dig in and make sure it's a large enough market. But what we also like to see with founding team members is, can you actually articulate what are the most important hypotheses that you need to validate to be true for this to be a valuable product in like a big enough market? And tell me how you're going to test those and validate those, and then what milestones you're going to reach by when, which is part of how much you need funding to do that part of the work. So we do a lot of work around milestone setting, kind of like what Michael shared. And initially, it may not be there, but we definitely love to stay in touch with folks, and some of being on the investor email list and watching teams over time definitely helps, because we can see your progress. And you said in 6 months, this is what we're trying to target and do. And when you follow through and get that done, those are all small points of confidence, to Nami's point. Even as a first-time founder, you can see, oh, they set these goals, they went and made them happen, and you like build your confidence in the founding team's ability to execute, even if it's their first time trying this. So I'll pause there. Hopefully that was helpful.
Yeah, that's a great answer. So thank you, and thank you, Michael, as well. And are there any specific questions or thoughts or insights that you look for during the due diligence process that are relevant for the fintech sector, that are unique and are not in any other sectors?
Not on my end, no. Sua's the expert.
Well, I'll just add, I think fintech and health tech, because I spend a lot of my time there, are probably two industries that are massive and growing rapidly, but also very highly regulated. So this is where my public policy degree and like some of my nerdiness on the, not just the business side, but the regulatory side actually is very helpful. And we actually try to make sure that you're going against regulatory trends and are actually going to have tailwinds behind you, again, instead of regulatory barriers that you're going to have to jump through many loops. And that's probably one thing that's different from if you're vetting a D2C company. Like, it's different from building the next Facebook. You can't just move fast and break things and make mistakes with people's money or their health and lives. So it's kind of, I think those are probably the nuances or differences when it comes to those two industries.
Right. Just as a founder, having gone through multiple fundraising processes as well, I can reverberate what Soa has said. A lot of the times in fintech, it is you need to show that regardless of what kind of industry you're in, like whether it's a B2C model or B2B model, you need to make sure that you are taking care of people's money, the highest amount of security, and just taking care and caution to build things, just from a regulatory perspective, because this is one of those fields where there's very, very, very good margin for error, and you cannot make mistakes, right? So an MVP in any other field is very different from an MVP in fintech, and I think, just from my experience, I think that investors just look for that maturity. And being highly ethical about your vision and your dreams, compared to many other industries where you may get a free pass and don't have to think about those things.
Thank you so much, Nami, and thank you, Soha and Michael, for that answer. So I want to move to the fourth group of questions that surrounds around social impacts. And Shalen, maybe you can open up by answering the first question. So not many people know that, but when you have a social impact startup, there is this thing called a social impact tax that you need to pay in order to actually build a dual mission startup. Sharon, can you maybe give us a brief on what the tax is? How did you feel that in your startup, and how should you relate to that as a founder?
Yeah, I think if you're building a company that purports to generate social impact, but you're still kind of vying for venture money, first and foremost, it has to be a viable business venture with venture scale. There's no forgiveness for the fact that you're helping people improve their lives. I think that additional criteria is you have to earn that on top of the basics of proving that it's a venture scale business on its own. But like I said before, I think aligning yourself with social impact objectives and metrics and goals, I think in the long run is good for your business. It makes you more sustainable. I think sometimes you have to get creative with the business models to be able to find the right risk sharing mechanisms and the incentive, the incentivization for the various stakeholders involved to be able to bridge that gap. But yeah, I think building a social impact company is not easy, and you might limit sometimes the pool of investors who might be interested, because immediately they might think that there's a haircut they have to take in order to in order to participate. So I'd say first and foremost, just think about the financial impact and try and align yourself to some broader objectives around how you're improving people's lives.
Yeah, and as a founder who's building mission-driven startups like Shailen and myself, I think goodness tax is very, very real, right? And as founders, what we have to do is we have to just first and foremost build a great business and let social impact be a positive externality of it, because there's no other way around it, right? Like, you need to be always thinking about your mission, but at the same time, first you need to prove out that you can build a good, sustainable business. And that's why I think, the task is obviously a little bit more difficult than, once again, many other types of businesses who may not face the same kind of hurdles. But then I think in the long run, and ultimately, I think the customers, the investors, anybody who believes in you and is ready to come on that journey is going to be the right set of investors for you and the right set of customers for you. And ultimately, you are building something that is going to make a positive dent in the world. And I think that counts in itself as a crowning achievement.
Do you mind if I chime in here?
Of course.
Yeah, no, I really appreciate those perspectives and feel very passionate about this topic, actually. That's one of the reasons why I pursued a joint degree myself, both in business and public policy, with the fundamental belief that those are probably the two greatest levers for driving change in our world. But I'm actually an investor now because I really believe that backing some of the most impactful startups could be the best and fastest way to scale impact. And I share this because my inspiration for this comes from Michael Porter, who's one of the most famous business school strategy professors at Harvard Business School. And I highly encourage the panelists and other folks to go and check out his HBR article on creating shared value. There's a false dichotomy that I think we had in the private sector for a very long time around the fact that you have to do the good stuff through a corporate foundation or a CSR kind of side program. But we all know what happens to those, like when budgets, during moments like that, when budgets get tight, those all shut down, and NGOs also struggle and shut down. And what I've come to realize is that when the core of your business model and the purpose and mission is aligned with solving a really, really big, hairy, challenging problem in the world, that's when you can build a really fantastic business and it becomes sustainable, to what both of our founders are speaking to. And that's kind of my dream, to be part of those businesses and to be partnering with those types of businesses. And I fundamentally think you need to be solving those types of big problems to have venture scale and really impactful, long-term, sustainable and scalable businesses. So I don't know, the industry will evolve, but I view the future of our world to live at a point of time where we will not be only evaluated by the financial returns, but also the societal and environmental returns across various industries. We're already seeing some of that being pushed in the public markets, and some founders here are also working on those problems, but I want to be a part of that in the private sector, in the private equity side as well, and hope to see many of you guys building great businesses. And don't assume that you have to pick impact or business. Like at the core of it, when you align that and find a business model that helps you solve that problem in a sustainable way, that's the most powerful engine you can actually use to drive impact at scale.
So I have a follow-on question. We spoke about social impact tax, but recently we've seen a bunch of startups that are actually focused around COVID-19. And relates to the topic of the panel of change during the COVID-19 era. Do you think there is also a COVID-19 tax, that if you're building a company around COVID-19, you need to prove that if COVID-19 is gone, you still have a viable business model?
Yeah, and I think this concept of tax is an interesting one that you use that language. COVID-19 is a crisis that's affecting different companies and different customers in different ways. So some are actually, it's weird to say that, but are thriving due to it, like remote work startups.
Yep.
or telehealth startups, for example. There's never been a bigger force that's actually driving more demand and need in that space, and you're seeing some of that. But a lot of them are also going to have to justify to the investors, once COVID-19 goes away, can you sustain some of this traction, and can you continue to build a business afterwards? So what's this current traction that you're immediately seeing now? Can that be sustained post COVID-19? Those are fair questions that everyone should be asking, and I don't consider it necessarily a tax, but part of how your understanding of the market and how you can sustain a business model beyond an immediate moment of time. And hopefully this is a temporary situation that we can address quickly, but I'll leave it at that.
Thank you. So before I address the last question, again, if there are any questions from the audience, please feel free to write them in the chat box so that we can gather them and ask the panelists those questions. So my last question is to Nami. So you have the title CEO, but CEO for you doesn't mean Chief Executive Officer, but Chief Empathy Officer, which is very unique. Can you tell us why is that and what does that mean?
Yeah, absolutely. So, when I set out to build Harvest, it was, I set out to build really social impactful product that can be helpful for the vast number of, average Americans that are out there who have been traditionally sidelined by, financial products that are, generally meant for higher net worth individuals. And, all of us know finance to be a very, very dry industry, right? It's all about data. It's all about numbers. It's all about making sure that you're making profit and, just a lot of different kind of misconceptions that are associated with the area of finance. But I wanted to build a financial services company and a fintech company that is good at the heart of it. And often, when you are trying to build a fintech product, most of the time you're looking just at the product, but not really looking at the human being behind that product, right? All of us have seen and read articles around how the average American is living paycheck to paycheck, how they don't have $500 in the case of an emergency. But then how often do we really step aside and think about the problems that typical person has to face if their paycheck comes 2 days late, or if their credit card debt goes all right, the vicious spiral that they're thrown into when they get one overdraft fee. So I really wanted to, make sure that while we are building a really, really cutting edge AI product, we put empathy at the heart and the center of the product that we're building. We wanted to put humanity as the DNA of this company that I was trying to build. So, I thought, okay, there is a lot of execution that is going to happen in this startup, and I am the founder and CEO of this, but if I can be an example in making empathy that first thing that you think about while building a product, especially when it comes to people's money and their livelihoods, it's something that, my team is going to be proud of building. And I personally have that ability to, wake up every morning so energized to build a product that truly matters and can help millions of Americans today. So empathy is truly is the DNA of our product. And I wanted to make sure that it is, something that I am constantly reminded of every single day as I set to build out this business.
Great, thank you so much, Nami. So now we have 2 questions from the audience. And since we only have about 8 minutes to go, I'm just gonna put both of the questions out there and allow all of the panelists to pick one of the questions they want to answer, or both, and just give each of you the opportunity to answer those questions, as well as give your final remarks if you want, and the message that you want everyone to leave with. So the first question is, do you see international bodies such as the IMF being major players in facilitating fintech development? And specifically, what kinds of initiatives or legislation could they provide to ensure more secure and fair industry in fintech? So that is one question we received from the audience. And the second is, what are some of the challenges around regulation when it comes to using fintech for financial inclusion? What do you believe is the best use case to foster great inclusivity and good within financial services? So I'm going to put both of those questions in the chat box, and while I do that, whichever one of our four panelists wants to give it a shot, feel free to unmute yourself and start the conversation.
I'm happy to jump in here really quickly. I obviously think that there's a role and specific need for regulation, but there's also, to the point that I was making earlier, a way to embed impacting good, almost like the way that Nami's talking about and Shailen's talking about, into the business model itself. So an example that I would give, for example, the insurtech industry is taking off, and insurance, if you think about it, is ultimately about risk. But what's really unique about insurance companies is that they have data that helps you understand risk at a very in-depth level. And if you are able to use that to not only monitor the risk level and actually help price it accurately, that's what insurance companies traditionally used it for, to kind of adjust premiums, but actually now use new technologies like AI and ML to proactively help mitigate the risk. That is a whole new kind of impact that you can actually have as an insurance company with data on customers. So that's part of, in many ways, like what Devoted Health is trying to do. We're seeing that in many other companies. So my perspective is that there's a role for regulations, and there's also just opportunity for innovation and embedding impact with the new technologies and the innovative business models that can shape how we think about it and pursue impact in the industry.
I'll pile on after that I think it's really difficult to predict with a fine tipped pencil, but I hate making predictions, but I think that the pace of regulatory change is only going to increase. If you look in the past 30 years ago to 20 to 10, you always ask yourself, who's dictating the regulations? And really, who's protecting who from what? And there's so much technological innovation that's happened to build into a lot of these industries where less oversight, less heavy-handedness, whether it's, put a laundry list here. I just think that the pace in which things will evolve and iterate here on the regulatory side is more likely than not to increase the rate of change versus decrease.
Yeah, I'd agree, especially when it comes to, fintech for financial inclusion, especially on the consumer side, you're already able to see so many, good trends that are happening, right? The rise of neobanks, the rise of no-fee products, very simple P2P or very simple, money transfer products that are extremely economical, which didn't used to be the same way before. Real-time ACH, there's so many different kinds of products that are coming front and center that generally would not have been possible before just because of too much regulation. But at the same time, right now, I think a lot of companies are finding workarounds or loopholes around that, right? Yes, there are neobanks, but none of them, actually many of them do not have their own charters, but they are finding partner banks to, do that bidding for them. And it has, really given rise to so many, I guess, almost decacorns now. At the same time, there are certain aspects of fintech on the consumer side that would benefit from more regulation, and we are seeing regulators be a little bit slow. For example, payday lending. Now, payday lenders have been extremely regulated for a long time, but there are newer entrants in fintech, some of which have business models that allow for skirting of the regulations, and they're charging like a huge amount of membership fees, but not really charging interest, and really providing the same kind of services to customers, but really not following any of the regulations that typical payday lenders are supposed to follow. Now, regulators have started to look a little bit into that so that they can, I guess, help foster that innovation, but at the same time, make sure that consumers are being treated properly and, the right set of rules are being followed without really stifling innovation. And so I think there's a very interesting mix of things. On the B2B side, I think there is, less regulation that needs to happen. On the B2C side, there are elements and there are, certain industry patches where there needs to be a little bit more regulation. And I think in general, there is this heightened awareness and attention around the fintech industry, in general, which it will benefit from, but regulation is going to have very varied impacts depending on whether it is lending that you're doing or KYC AML, just vastly different elements within the same industry.
I'd also add that it's not always regulation that's the barrier to adoption. I think usually if you're not being empathetic to your users and who they really are, I think there's simple UX fixes that can increase adoption. And we deal with lower income individuals who not very many of them have iPhones and they don't trust apps. They don't want to give their financial details. They don't want to log in and but there's ways that you can kind of build that trust within the workflow of the app. And we've done a lot of work on that front, and by speaking to the end users on the ground and like not assuming that, what problems they have and just listening intently. I think there's a lot of innovation that can be done within the confines of today's regulatory environment or technology environment. I think, we should all kind of be open-minded to speak to more users and speak to the people we're trying to help.
Thank you, Shalen. And with that, we are at time. So I want to first thank all of our guests for joining us. And I especially would like to thank our amazing panelists, Michael, Soha, Nami, and Shalen, for taking the time and answering all those questions and for your amazing insights. This has been a great discussion, and personally, I've learned a lot. So thank you. Please don't miss the next FinTech 2020 events, and check them out and register today at harvardae.org, which is also in your text box. If you're a Harvard alumni and are not yet a member of this amazing community, don't wait any longer. Countless benefits, from free events to exclusive mentorship program through our Connect platform, are available once you join. So stay tuned, and I hope to see you all next week. Thank you so much.
Thank you so much, Shai.